The chairman of Libya's newly founded National Oil Corporation has said that Libya's oil production will begin within weeks and reach full pre-war output within 15 months. Libya was producing 1.6 million barrels per day before an uprising began in February against the leader, Colonel Muammar Gaddafi. Joining us now to assess the oil sector and the sovereign risks that exist in Libya is Jan Randolph, who's head of sovereign risk at IHS Global Insight. Jan, thanks so much for your time. Let's talk about what it takes to revive. Let's talk about what it takes to revive Libya's oil industry. The National Transitional Council believe that very soon they could get to pre-war production levels. Is that realistic?
Well, where are they at the moment? They used to produce 1.6 million barrels a day, about 2% of the global supply, but that's down to less than 100,000 barrels. That kind of collapse is mirrored in the economy. The economy was at its peak, 2008, $95 billion. It's now less than half that size. So the economy has contracted by over half, and certainly more than mirrored that in oil and gas production. But having said that, the infrastructure by and large is still in place. Some of the damage could be quickly repaired as long as the security situation is there. They can ramp up a lot of the output and production and exports fairly quickly. We think as long as the security and the politics are right in the next few months, they could get production back up quite quickly within the next 6 to 9 months.
Who will their strategic partners be? Because right now investors looking into the horizon are concerned whether they will honour existing contracts, whether there will be a review of power sharing agreements, and who they'll do business with. We already know that they are quite fed up with the Brazilians and the Chinese for not backing sanctions at the UN against Colonel Gaddafi, and many people see that as indicative of where their biases will lie in terms of investments.
Yeah, I mean, it's very interesting, and these issues are discussed ahead of potential existing investments and future investments. I think given the current situation, I think they'll want to keep most of the contracts in place. They need to get all the oil out as they can get. Having said that, it's true, you know, a new sovereign authority has the right to reopen contracts, and I think this will probably affect new contracts rather than existing ones. And it's certainly the case that the new Transitional Council would be understandably favourably disposed to those that supported them from the outset. And that is, of course, the French and the British, and also the Italians, where they have a longer standing and deeper relationship because the obvious economic complementarity between Italy being a close market and Libya being a close source of energy for Italy.
Let's talk about growing the oil industry. We know that Libya has proven reserves of 1.3 million barrels of oil. Many people say there's a lot more to offer, but under Colonel Gaddafi, he was very cagey about issuing prospecting licenses, really preferring indigenous ownership of oil assets. Will the Transitional Council have a different approach to prospecting?
It's a very good question. I think we've got to take a perspective here. It's only in recent years, since 2003, when sanctions were lifted after Gaddafi renounced weapons of mass destruction, that Western oil companies managed to get some toeholds, and we are talking about toeholds only, into the oil and gas sector. It was very slow and tentative, and there's a lot of potential. Up until then, it was basically off bounds. Libya was under sanctions. The Americans originally were expelled back in 1986-87. So we really are talking about a very closed economy, with most of the oil and gas sectors under the singular oversight of Libyan interests, with only tentative toeholds made over the last few years. There's a lot of potential. And then certainly, you know, Libya is on every oil and gas company's radar. And it is favourable for them because low cost of production, high quality oil, very close to European markets, the infrastructure's already laid down, very small population. These are all positives that Iraq didn't have.
Let's talk about very high quality oil and just educate me here. We know that Libya supplies around 2% of global output. But what makes it so strategic? We're told that they have a variant of sweet crude that doesn't make it difficult to refine, and this is why everybody wants their hands in it. Just tell us about that oil, and once we start seeing Libyan oil on the world markets, how will that influence prices, do you think?
Well, there are three aspects to Libyan oil. You mentioned the low sulfur content. That's always the preferred oil for refiners. It's easier to process, and you produce a higher quality derivative, including kerosene for aircraft. The other aspect of Libyan oil, it's easy to access. There's a low cost of production. In other words, the unit of barrel of oil, the unit of barrel of oil has a low cost element to it, easy and cheap to get out. And thirdly, it's right next door to European markets. The infrastructure, the pipelines have already been laid, so transportation costs are very low. The final issue about whether it will affect the world price or not, at the moment the world market price, we're seeing the wind being taken out of the oil price and the gas price because of the global economic conditions are weakening. We're seeing a weakening in global demand, and they are the overwhelming influences when it comes to oil prices. Whether Libya produces currently 100,000 barrels, or whether it can ramp up to 1.6 million barrels, which is the current invested capacity, will not have any effect on oil prices whatsoever.
And finally, sovereign risk issues for a new government that needs to try to improve on its credit rating, that needs to start borrowing, that needs to reconstruct the country. What do they have to tap into? Because we know that Libya had some sort of a sovereign wealth fund in the Libyan Investment Corporation. They have assets valued at about $60 billion. So there should be some money that they can tap into. Is that enough?
It's very interesting. The sovereign risk angle will look at the balance sheet. Libya's got huge assets. You mentioned foreign exchange reserves, 60 billion, plus gold, 6 billion, sovereign wealth fund, 60 billion. We're talking about over $130 billion worth of assets. And on the debt side, hardly any debt, less than 1 billion. This is an extremely financially strong net creditor nation. They could quickly release a lot of the cash, foreign exchange, to bring in all the imports they need to avert a humanitarian crisis. We're talking about food, fuel, drugs, electricity, water, you name it. They can afford it as long as the new sovereign authority acquires the rights to these sovereign assets, and that's the key point. Once they acquire the rights to these key assets, they will have no problem financing all they need to rehabilitate and kickstart the economy. What they really need further down the line, though, is a return of the immigrants from the migrants from Egypt. Because with such a small population, they were heavily dependent on migrant workers to keep the economy ticking over. And many of them have left, and they need to come back. And further down the road, the Libyan Investment Authority, this was a sovereign wealth fund set up in 2006, 2007. It would be ideally suited to make investment in infrastructure with the two neighbors, Tunisia and Egypt, both part of the Arab Spring, to develop all sorts of trade and cross-border investment. To build mutual advantage regional economic development. So the Libyan Investment Authority can play a very important role here in terms of regional development with two friendly Arab Spring neighbours.
Thanks so much for your time and insights there, Jan Randolph, who's head of sovereign risk at IHS Global Insight, talking to us about the Libyan situation and rebuilding that country.